One of the most important questions that most students lose out marks on is theory questions, because most learners don't do theory questions. They don't study them, they don't practice them, and that gives you a huge disadvantage in the examination room, because those questions carry a lot of marks. And that is why in this video we are going to look at the 2024 preparatory paper, focusing on question 3 and question 4 that deal with interpretation of financial statements, profitability, liquidity, risk and gearing, share prices, dividend policy, and payout. And we are also looking in question 4 at corporate governance. All of these are theory questions, and we are going to practice how to answer them effectively. To make life simpler for you, you need to know how to interpret. What are the things that you are looking for when you are interpreting? So when you are interpreting financial information, you are looking for what we call areas of interpretation. So there are specific areas that you are looking into. You're not just talking about anything. You are looking into specific areas, and those 5 areas are profitability, liquidity, solvency, return, and gearing. And then we are going to look at what does it mean when I'm looking at profitability, what do I mean when I'm saying I'm looking at liquidity, and how do I interpret based on it. So for example, starting with your profitability, you need to know what profitability is. Profitability, when you're commenting or interpreting the profitability of a company, you are interpreting the efficiency in their operating activities. Operating activities, I mean their day-to-day, whatever their business is. If it is selling IT goods, then that's what you are calling your operating activities. How efficient are they? Are they able to make profit from that activity? And the indicators, or the financial indicators that help you identify whether the business is able to make profit from what they are selling or whatever their service is, percentage gross profit on sale, percentage net profit on sale, percentage operating expenses on sale, percentage operating profit on sale, percentage gross profit on cost of sales. You will see all of those indicators talk about sales and cost of sales and the expenses. These are the operating activities, the day to day. At the end of the day, for us to sell a product, what would have taken place and how much profit would we have made and how much is our sales. The second area of interpretation is liquidity. For us, when we are saying, is the company liquid, or what is the liquidity of the company, or comment on the liquidity of so company, what are we looking for? We are looking for the company's ability to pay off its short-term debt, only short-term debts. So we are talking about current liabilities, and usually to pay for your current liabilities you need to use your current assets. So you will see that the ratios that we are looking at, or the financial indicators that we are looking at, we start with a current ratio. If you know a current ratio, you know that it is current assets is to current liability. So you will see, and we are using our current assets to pay our current liabilities. Asset test the ratio, debtors collection period, creditors payment period, stock holding period. All of these things fall under current assets and current liabilities. Even when you look at the formulas, you will see they all are things that are involved in current liabilities and current assets. Using current assets to pay for the current liabilities. Current liabilities are my short-term debts. And then area 3 is solvency. When we are saying, is the company solvent or insolvent, and when we are saying interpret on the solvency of the company, what are we looking for? Now we are looking at the company's ability to pay off all of its debts. Liquidity is only short term, solvency is all of the debts, meaning short term and long term, current and non-current. And they have only 2 financial indicators that help you determine if the company is able to pay off all of its debts, and that is a solvency ratio and net assets. Net assets, basically we are talking about your total assets minus your total liabilities, are you left with something? Whatever you are left with is your shareholders' equity. That shows if you are able to pay off your debts. Then in area 4, we are looking at return. In return, usually it is for the interest of the investor. We are looking out for our investors, or in other terms, our shareholders. What shareholders are earning on their investment. So we want to know that if I invest in this company, am I going to get something tangible? So that is your percentage return on shareholders' equity, earnings per share, dividends per share, and net asset value per share. These indicators are telling me about if my investment is earning a good return. And then the last area of interpretation is risk and gearing. You are looking at the type of risk and the gearing the company is under. So this is, what is the company financed by? Is it financed by capital or it's debt? If you are financed by capital, then we are saying you are at less risk because you are financing yourself out of your own capital. But if you are financed by debt, that's when we are saying you are at high risk. It means that everything in your business depends on your ability to be able to pay all of your creditors. It means that when you need to expand, for example, you don't have money of your own, you have to go now look for a loan. So you are a high risk company. And the indicators that show us this is the debt equity ratio and the percentage return on total capital employed. So starting with question 3, we are looking at interpretation of financial statements for Butler Limited. It says required note: provide figures, trends, financial indicators, or calculations in each case to support your comment and explanation. You see, it's about commenting and explanations. It continues to say the information relates to Butler Ltd, a company providing IT services and support for the financial year ended 29 February 2024. 3.1 wants you to choose a category of indicators from column B and match it with the descriptions in column A. 3.1.1 says the ability of a business to settle all its debts. Which area of interpretation is this? It is solvency. Solvency is C. So like we have went through in our areas of interpretation, the way they are, they will not change. Dealing with all that is solvency. 3.1.2 says the benefit that shareholders receive for investing in a company. So what is my investors getting in return? So that would be the return area of interpretation. So in column B, it says return on equity. So anytime we are talking about shareholders benefiting or investors benefiting, that is return. And then 3.1.2.3 says return on total capital employed. Where did you see the financial indicator of return on capital employed? You saw it in risk and gearing, but really it talks about gearing. It talks about how much is being financed by what, and that is gearing. So in 3.2 we are looking at more questions on our areas of interpretation. And in profitability, it says shareholders are complaining about the irresponsible price decreasing during the 2024 financial year. The directors maintain that the price is of significant importance when compared to competitors. Justify the directors' decisions. Quote 2 financial indicators with figures. So what am I going to look at? Profitability. I'm going to look at the first 4 indicators, particularly gross profit on sale, because gross profit is so direct. We both know what gross profit is: sales minus cost of sales. So when you have gross profit on sales and also net profit on sales, like profit is so straightforward. So when you are looking for profitability indicators, just look at the financial indicators that have profit on them. So if you forget them, that's your clue. So you are looking at those financial indicators. Now, if you paid attention, you will have seen that percentage gross profit on sale increased from 20.1% to 28.2%. That means it's an increase by 8.1. This is me showing my calculation. So I indicated the financial indicator, it's percentage gross profit on sale, and I talked about my figures there. The same thing with net profit on sale, it increased from 16.3 to 22.0, and that is an increase by 5.7%. It is so simple to get your marks. There is a mark for identifying the financial indicator and marks for showing your figures. To show your figures is what was it, what is it now, and what is the difference. It's as simple as that. In 3.3, we are moving to liquidity, and it says comment on the net working capital of the company, code 2 financial indicators with figures. Now, liquidity works with working capital. Working capital, we are talking about inventory, debtors, and creditors. All of those things fall under current assets and current liabilities, and that's what the area of liquidity is about. So our ratios or our financial indicators for liquidity, we are starting from that part of current ratios to stock holding period. All of those 4 indicators speak of my liquidity. So for this question, what I'm going to look at, I'm going to choose to comment on the 2 that I'm choosing to comment on will be a debtors collection period and a stock holding period. You can comment on any of the 4 that you choose, it will still work. So I'm choosing to focus on a debtors collection period that used to be 31 days, now it's 58 days, and a stock holding period that used to be 54.6 days and now it is 76.9 days. Why am I choosing those 2? They're easiest to talk about. When something has been extended in days, you know that 58 days is more than 31 days. I don't have to tell you that. So my comment is that they have a challenge with turning their receivables into cash, and their stock takes too long to sell. Their receivables, I'm talking about their debtors. Their debtors take too long to pay them. They used to pay me in 31 days, now they pay me in 58 days. That is not something that is complicated to understand. And then my stock, I used to be able to sell it in 54 days. Now it takes me a whole 78 days to be able to sell it, and that's me stating there with those 2 bullet points. Debtors collection period is my financial indicator. It increased from 31 days to 58 days by 27 days. And then the second indicator is a stock holding period that increased from 54.6 days to 78.9 days with 24.3 days. It's as simple as that. Identify the indicator, show the calculation, and I had already started with my comment. In 3.4, I'm now in the area of interpretation called risk and gearing, and it says explain how the issue of shares has affected the financial risk and gearing of Butler Ltd. Code 2 financial indicators and figures. Now, you are in risk and gearing, so you're both looking at risk and gearing. How much risk am I in? How much am I financed by that? And gearing, what is financing me? Capital or is it debt? Again, the indicators that show me that would be the debt equity ratio and the percentage return on capital employed. Debt equity ratio used to be 0.9:1, now it's 0.4:1. And then the return on average capital employed used to be 7.5%, now it's 16.9%. So there is, in my information, there is where they indicate, I want you to keep this in mind, that the interest rate that I operate at is 7.2%. So when you are talking about percentage return on capital employed, what you are looking at is how far off is it from the interest rate. So let's start by talking about the debt equity ratio. Now you can see that it decreased. It used to be 0.9, now it's 0.4. This reduced the risk of the business. So why are we saying that it reduced the risk of the business? We are saying we want debt equity ratio to be low. Why do we want it to be low? We want the debt to be low. So you see in the debt equity, so the 0.4 represents the debt, the 1 represents the equity. So it used to be 0.9, now it's 0.4. It went down, so that is good. And then the return on capital employed increased from 7.5 to 16.9 by 19.4, and this is good because it increased so far from the interest rate of 7.2. Remember I told you the interest rate is 7.2. It's somewhere in our information there when you look at it proper. So you want it to be higher than the interest rate as much as possible, and 16.9 is way higher, and that's good. 3.5, we are looking at share price and shareholding. Refer to information C and D. Bullet number 1 says, explain why the directors should be interested in the price of the company's shares on the JSE. If you're not familiar, the JSE is where the shares of public companies are being traded, and the price that is advertised on the JSE reflects the market price of your shares. So the reason that you should be interested, it means that the market value will attract more investors. If you have a higher market value, it says to people that your shares, the shares in your company, are actually much valuable, and they will get a better return if they invested in your company. So if you have a higher market value or a higher market price, then it will invest to you more investors or more shareholders. The second bullet says, comment on the price of the new shares issued in February 2024. Give a reason why shareholders should not be satisfied with this price. Quote 2 financial indicators and figures to support your answer. So basically from this statement we understand that there is a price for our shares on the JSE, and whatever that price they have set, our shareholders are not happy about it. So you are quoting figures to support why they are not happy. So you're not giving your opinion on whether they should be happy or not. We already know that they are not happy, and we want reasons to justify their unhappiness. So you will look at the number of shares that are issued there on 28 February, and it says they were issued at 1,750 cents per share. So that would be the market value that we have decided to sell our shares on, or the share price that we decided to share our shares on. But then we look at the market price on the JSEs. These shares are actually worth 1,920 cents. So basically we sold them for less than what they are worth on the JSE. So you see, now it's starting to make sense, the dissatisfaction of our shareholders. And then you will also see that the net asset value per share, meaning the value of each share. What is the value of each share now when they stand on their own? It's 1,847. Still, that price of 1,750 is still lower than that amount. So to comment, the first bullet, the new price of 1,750 cents is less than the market price of 1,920 cents by 170. So you would have put that in your calculator to get that. The second bullet, the price of the new shares is also lower than the net asset value, so you can abbreviate it to NAV, of 1,841 cents by 91 cents. The comment, the company is losing out on additional funding they could have added to their capital. So we could have been making all of this money, and we are losing out on it. Instead of selling them at 1,750, we could have sold them at 1,920, and then that money will be adding to our capital. Hence that comment in the end. The next bullet point says, a majority shareholder, F. Ngumalo, currently owns 1,272,000 shares in Butler Ltd. He is considering selling some of his shares in the next financial year. since he needs money to buy a new car. Calculate the maximum number of shares that he will be able to sell without losing his majority status. Assume that all other shares stay unchanged. Okay, so out of the 1,272,000 that he owns, he's trying to sell some of it. But the catch here is he's trying not to lose his status as a majority shareholder. So he wants to sell the shares but still become a majority shareholder. So we need to know how much can he sell out of this 1,272,000 and still remain a shareholder. You see, now he's a shareholder because he has 53%. Anything above 51 makes you a majority shareholder. So now we are looking, the company itself, Butler Ltd, has a total issued shares of 2.4 million. So out of this 2.4 million, what we want is to make sure that he has above 50%. And then to that 50%, we are going to add one more share. But then you see that note a little above, it says shares are sold in lots of 100. So keep that in mind. So I start by calculating 50% of the 2.4 shares that are in issue. So 2.4 million multiplied by 50%, it gives me 1.2. But to be a majority shareholder, I need 1,201 at the end. Why? Reason being, if I have 50% and another person has 50%, we will both be majority shareholders. I want to be the majority shareholder, so I have to have an additional one. It's important that I have that additional one. But my problem is that note that said they sell them in lots of 100. So I cannot just buy one share. I have to buy a full 100. So you will see to the 1.2, I add 100. So then I have 1,200,100 shares. So that's what's going to make me a majority shareholder. So I will take his shares of 1,272,000 and I will minus 1,201 and it gives me 71,900 shares that I can sell. In 3.6, we are looking at returns, earnings, and dividends, and it says directors changed the dividend policy for the current financial year. The first bullet says, explain how the company managed to fund the high dividends without using borrowed money to make the shareholders happy. Provide 1 point with figures. So here they are telling you that at the end of the day, we made sure that our shareholders were happy with what they got. But we did not use borrowed funding. So this is a solvency issue where we are talking about if you're not going to use debt to make your shareholders happy, that means you used your capital. So we are going to look at how did we raise capital in order to make our shareholders happy. What we did, you will see on the 31st of August, we repurchased shares. And then these shares that we repurchased, in the next one, you will see the number of shares issued to existing shareholders. So for us to be able to issue the shares to the existing shareholders of 340, we have to start by buying back shares in order to give them to the existing shareholders. So what they did is the profits of the 240 shares that were repurchased will be redistributed to the existing shareholders. So instead of going to find debt in order to satisfy our existing shareholders, we just simply repurchased shares, some of the shares, and then took the proceeds from those shares and redistributed them to our existing shareholders to keep them happy. The second bullet point says, explain the change in dividend payout rate and give reasons for this change. Code figures. Now they're not saying if we are happy or unhappy with it. We just want to state the difference and then give a reason why you think this change was made by the directors. So we are going to go back to our information and look at our dividend payout rate. We see in 2023 it used to be 96% and now it has decreased to 80%. So you will quote with figures that it used to be 96, now it is 80, and then give us the reasoning as to why you think the directors did that. So the dividend payout rate decreased from 96% to 80% by 16%. This is you showing figures. Always show that calculation. Now, why do we think the company did this? So dividend payout rate is how much we are paying for each dividend that our shareholders own. So we used to pay them 96% and now we pay 80%. That means we are saving. And why would we be saving? The company is retaining funds for future expansion. So basically we are saying we are just going to keep some of our money for the business in order to be able to expand in future should we need to. And then in the last bullet point of 3.6, it says, explain whether the shareholders should be satisfied with the earnings and returns of the company. Code 2 financial indicators. So they're not telling us if they are satisfied or unsatisfied. We are the ones who are going to decide. So you're going to choose the financial indicators that are going to support your stance. So looking at our earnings and returns, you can look at the earnings per share that used to be 125 cents and now it is 200 cents. And then you're also looking at a percentage return on shareholders equity. It used to be 10.3 and now it is 12.7. The question is, should the shareholders be satisfied or unsatisfied with that? So let's start by just quoting the financial indicator and showing the figures and get that out of the way. EPS, that is earnings per share, increased from 125 to 200 by 75%. ROSHE, which is a return on shareholders equity, increased from 10.3 to 12.7 by 2.4%. Should the shareholders be satisfied or not? We say the shareholders should be satisfied because the company is generating more profit per share and increasing the value of their investment. So when you see those two figures increase, this is a good thing for our shareholders, our existing shareholders. It means when they need to resell, they will make more, and that's why they should be satisfied. In question 4, we are looking at corporate governance. It says you are provided with an article about an internal auditor who has been found guilty of misconduct. Use the information presented and your knowledge of companies to answer the questions. In 4.1, it says shareholders of Ekurhuleni Ltd will not be happy with the audit report of the past 5 years after the recent findings. Explain what an unqualified report is and why the shareholders will not be happy. So before we explain what an unqualified report is, we will have to go to our information to find out what has been happening with the audit report of Ekurhuleni Ltd. So going to our information, it's titled Rinse and Repeat the Ongoing Saga at Ekurhuleni Ltd. An internal auditor has been found guilty of serious financial misconduct, including mismanagement of funds and the falsification of accounting records. This shocking revelation has highlighted the vulnerability of organizations to internal fraud. Mr. Gell, who was supposed to be the watchdog, turned out to be dishonest. Ekurhuleni Ltd has been receiving unqualified reports due to inaccurate financial reporting. The individual entrusted with ensuring financial integrity breached that trust by misappropriating funds for personal gain and tampering with accounting books to conceal their action. This breach not only undermined the organization's financial stability but also eroded trust in governance. Restoring confidence will require a concerted effort to strengthen transparency and accountability throughout the financial sector. Our question started by asking us what an unqualified report is. So before we answer that, we need to understand what are the 3 different types of reports we can get from our auditor. Our auditor can give us a disclaimer, which means they had no evidence and therefore they could not necessarily conclude without knowing the full story of what happened. And then there's a qualified report. A qualified report, it means they have evidence and the evidence is bad. Unqualified report is what we are looking for. It's a good report report that says our financial statements are correct, accurate, no biases, and they comply with accounting standards. So to answer our question, an unqualified report is a report that indicates that the statements are free of significant errors, fairly represent the financial position of the company. That is why this is the type of report we actually want to receive, because it tells us there's no errors in our financial report, the accountant did a good job, and there is a fair representation of where our company really stands. And why is the shareholder does not happy? Well, remember they said the shareholders of this company has been receiving a qualified report for the past 5 years, but that was not the truth. So the reports have been misleading, and this will affect the share price. When people find out that the company that they thought was doing good is not actually doing good, the prices of their shares will start to lower on the JSE, and that's why this is not good. In 4.2, it says, an auditor serves as a watchdog regarding several important functions to ensure transparency, accountability, and compliance within the company. Explain 2 key functions of an auditor in the company. So to be able to explain the 2 key functions of an auditor in the company, it really just comes from you understanding what an auditor is. So if you know the definition of what an auditor is, it will be easy for you to know what their function is. So what is an auditor? An auditor is a professional who is responsible for examining and evaluating the company's financial statements to ensure accuracy, meaning no frauds, and compliance with the relevant accounting standards. These 2 things are the most important things. We want to ensure accuracy to make sure that there is no fraud, and this will also help us prevent fraud. And compliance with the relevant standards. Which standards? The accounting standards that you are supposed to record your books in accordance with. So we don't just record, there is a standard that we need to follow. So from those 2 things, what is the functions? The first function is examine statements to detect and prevent fraud. That's where that accuracy is coming in. If the books are recorded accurately, that means that we will have the source document to verify everything that has been recorded, and that will be the job of an auditor. He will examine using source documents, and that will prevent any type of fraud. And then the second one is to verify compliance with the relevant accounting standard. Just as we have discussed, we don't just record, we need to follow accounting standards. In 4.3, we are looking at shareholders' concern and company reputation. It says, as a shareholder, explain 2 effects that will be a concern based on the findings in the article. Now, pay attention to that. This says that this information that we were reading, it is an article. So this information that we are looking at, this is an article. It's an article that has just come out exposing that in our company for the past 5 years, we have been getting an unqualified report that we were not supposed to be getting. And funds were misappropriated, and the auditor rather had eroded the trust and the governance of the company without the company being able to see what is this going to mean for our company. That's what we mean by concern. So first things first, the company will have a bad reputation or an image. So this says to the whole world that whatever the market value of our prices was, you cannot trust it anymore. There's bad management in our company. Hence, the second bullet point says they will lose confidence in the management of the company, because people will ask, how can this go on for 5 years without you finding out? So these are the most appropriate, straightforward answers that you can put out there. Then in 4.4, it says the CFO of Ekurhuleni Ltd has emphasized that maintaining financial data integrity is crucial for the company to ensure accurate reporting, compliance with regulation. State 2 practices that can help to maintain the integrity of accounting records within the company. So this is just off of general knowledge. What are the 2 things that we can do to maintain integrity in the company? First of all, we can train and educate our employees regularly, keep them up to speed as to what are the new accounting standards that they're supposed to be putting in place. And then we can also establish clear policies and procedures, clear policies that will ensure that accounting records follow the proper procedure before they are recorded, and they are also examined and verified properly. To have YouTube recommend you more of my videos, be sure to click the like button and subscribe to the channel. And if you have any questions, leave them in the comment section below.